Hello and welcome to this recording about relevant costing. Relevant costing is used again for short-term decision making, and the theory behind relevant costing is that the only costs which should be considered in decision making are those which will be altered as a result of the decision. And those are the costs that we consider to be relevant costs. So in other words, relevant costs are those which will be affected by the decision being taken. If a cost remains unaltered, regardless of the decision being taken, then it's called non-relevant. Now, to help you decide whether a cost is relevant or not, we look for three characteristics. The first characteristic that we look for is whether it is a future cost. By that we mean that it hasn't yet been incurred, but it will be incurred in the future if we go ahead with a decision. Costs that have already been incurred are past costs. They're irrelevant and they're often referred to as sunk costs. The second characteristic of a relevant cost is that it must be an actual cash flow. So depreciation is irrelevant because it is not a cash flow. And the third characteristic of a relevant cost is that it should be incremental. So the relevant cost is the difference between what happens if you go ahead with the decision and what happens if you do not go ahead. So it's incremental, it changes depending on whether you go ahead with that decision or not. As a general rule, variable costs tend to be relevant and fixed costs irrelevant. So let's take a look at an example. We're going to identify whether some costs are relevant or not. So firstly, a salary to be paid to a market researcher. They will oversee the development of a new product. It's a new post. £12,000 salary will be a fixed cost. Is this cost relevant to the decision to proceed? So it is a fixed cost, and we have just said that generally variable costs are relevant and fixed costs irrelevant. But here is an example where it is a fixed cost, but it could be relevant. So we need to consider the three characteristics. Firstly, is it a future cost? So is it going to be incurred in the future, or has it already been incurred? Well, it's not yet been paid, so therefore it is a future cost. Secondly, is it a cash flow? So yes, it will involve an actual outflow of cash. And thirdly, is it incremental? So will it change depending on whether the decision goes ahead or not? Well, if we don't go ahead, we won't create the post, so the salary will be zero. If we do go ahead, we will create the post and the salary will be 12,000. So it is incremental. So therefore, it is a relevant cost. So now we'll take a look at a second example. So here we have £2,500 of additional monthly running costs of a new machine to be purchased to manufacture an established product. Since the machine will save on labour time, the fixed overhead to be absorbed will be reduced by £100 per month. So we have two things to think about here: the additional monthly running costs and the overheads absorbed. So considering the running costs first, £2,500, is it a future cost? Well, we can confirm that it is, because they will be paid if we go ahead with the new machine. That hasn't yet happened, so it is future. Is it a cash flow? Yes, it is. And is it incremental? Again, there's a clue here because it says it's additional monthly running costs. So we will incur them if we purchase the machine, we won't incur them if we don't. So it is incremental. So therefore the relevant cost is £2,500. But what about the £100 a month reduction in our overheads absorbed? So again, we apply the three criteria. Is it a future cost? Yes, it is, because it's only going to happen if we go ahead with the new machine. Is it a cash flow? Well, the answer is no. It's an overhead absorption rate we're using to absorb our overheads. Overheads absorbed are not an actual cash flow. It's only when we incur the overheads and receive the invoices that it's a cash flow. So here we're just talking about an adjustment. So it's not a cash flow, so therefore we don't need to consider the third criteria because we know it is not relevant. And finally, a third example. Expenses of £75 paid to the marketing manager. This was to reimburse the manager for the cost of travelling to meet a client with whom the company is currently negotiating a major contract. Is this cost relevant to the decision to continue negotiations? So firstly, future. Is it a cost that's going to be paid in the future? The answer is no, it's already been paid. Therefore, it is not relevant. So we don't need to go any further. If it's not a future cost, it is not relevant. So those three are a useful way of trying to decide whether a cost is relevant or not. Is it going to be incurred in the future? Is it a cash flow? And is it going to be incremental? Finally, we need to think about opportunity costs. Opportunity costs are costs that arise when a company goes ahead with a particular decision, using up a resource that has other alternative uses. Since a particular resource can only be used once, it means that when we use it for one means, we've lost the opportunity of doing other things with it. And that lost opportunity, or the benefit from the lost opportunity, is known as the opportunity cost. So if we look at an example to illustrate that, we have 100 kilos of material which was purchased for £5 2 years ago. We can use the material for a special job, or we can sell it for scrap. So it's got a scrap value of £2. What is the relevant cost? So we need to work out what the relevant cost of the 100 kilos of material is. Now, whenever you have a question like this, always look to see if there's any costs that you can eliminate. Now we were told that the material was purchased for £5 2 years ago. So that £5 was paid in the past. It is not a future cost. So for the purpose of identifying whether the cost is relevant or not, the £5 is not relevant. So we'll cross that through. So we're left with just the scrap value of £2 per kilo. So the relevant cost of this material, 100 kilos at £2 a kilo, which is £200. Just to confirm that it is in fact an opportunity cost, we've got two options here. We can either sell the material for scrap, in which case we would get £200 for it, or we can use it on the job. If we use it on the job, we lose the opportunity to sell it and earn £200. So the opportunity cost is the lost opportunity of selling the material for scrap at £2 a kilo, hence opportunity cost, which is the relevant cost, is £200. So that briefly explains relevant costs. If you bear in mind any question that you're looking at, think about those characteristics of a relevant cost. Is it a future cost? Is it a cash flow? Is it incremental? So that's your test. Is it future? Is it a cash flow? Is it incremental? Also then look and see if you need to consider any opportunity cost. So for a particular material, or it could also be labour for a particular type of labour, is there more than one option for using that resource? And if you use your resource on one option, have you foregone the opportunity to use it for another option? So those are the things to bear in mind. Another little tip I would just give you is that with any question that you may have, or any example that you're looking at, always see if you can eliminate any costs first. So pick out any cost that's sunk. If it's a sunk cost, so in other words it happened in the past, then for your relevant costing decision making you don't want to include that. So you can immediately eliminate those costs. So it's only a short video, but I hope it's been helpful to you in calculating what are considered to be relevant costs. Thank you for listening.